All right, guys, let me save you from something I see every single year from new clients. End of January hits and people start getting all of these documents and little tax forms rolling in the mail or email. These could be W-2s, 1099s, K-1s, maybe a random one from an app that you forgot you used throughout the year. And suddenly everyone becomes a detective. What am I being paid? Where do I put this? Do I keep this somewhere? But it's not like this good detective. It's a panic detective. And here's the truth. Your tax forms do not lie, but they're also not telling the full story at all. And if you don't know how to read them, you're either about to overpay, underplan, or spiral out of control. So today I'm going to teach you how to read your forms like a CFO, calm, strategic, and 2 steps ahead. Welcome back to Spicy Takes and Tax Breaks, where we mix strategy, sarcasm, and the things your tax preparers should have explained years ago. I'm Aubree Denekamp, the write-off queen, and this episode is your January reality check. What's arriving, what it means, and where people mess it up most often. And now, how to fix it while the options are still open. If you're listening right now, grab your notepad or notes app because people who win it at taxes are not often smarter. They are earlier to the game and either have a plan or work with someone who manages that plan for them. And here's what I see happen every single year. People treat tax forms like a grade on a report card. They pay 0 in, one number, and immediately decide how to feel. Oh, I owe nothing. I'm getting a refund. Yay. Or shoot, I owe a lot. And almost no one stops to ask the more important question, in my opinion, and that is, what have I already paid towards this liability throughout the year? Because by the time you're looking at a spring tax liability, many of you have already had more than a third of your total income taken out through withholdings over the course of the year. Payroll often does that quietly, very automatically, before the money ever hits your account or you see it. So when people fixate only on what's due in April, they miss the bigger picture here. How much was already sent in, whether that was through withholding, intentional or accidental, prepayments, and whether that total tax actually makes sense for their income situation as a whole. And that's what I want you to pause here and think about. Tax forms are not a grade, they are receipts. They are proof that what you reported is correct based on what your employers, clients, banks, other platforms are reporting about you. And it's not an emotional judgment on how you did throughout the year, unless you're looking at it from a different income standpoint. But this matters because the IRS doesn't take a look at this in consideration to your feelings. It starts with automatic matching. And if what you report doesn't match what they've already have on file from everyone else, that's when the letters and notices start kicking in. And these often come months later after interest has time to accrue and penalties, etc. So your job in late January is not to panic about what you think you might owe in the spring. It is going to be this year to start an audit and create a paper trail for everything. What was earned, what was reported, and what was already paid on your behalf throughout the year. Once you understand that, the anxiety drops tenfold, and you can actually start to create a plan, whether that is for 2025 or looking into 2026. And this is where the difference mainly between W-2 income and other sources of income really start to matter. Because some of you have already paid a large chunk of your tax bill through these withholdings, through your W-2, while others haven't paid $1 yet, even though the income is already on the record. So let's start with the W-2. Most people look at the W-2 and only see, this is what I made throughout the year. But if I want you to take a look at this as a CFO structured look, it's how much was withheld, what benefits were run through payroll, was there retirement contributions that potentially reduce your taxable wages, did my employer code all of this correctly, and does this match what I was paid and what I think I made? So what to look for in the most simple basic version is going to be box 1, wages. This is not always your salary. It is your taxable wages after certain deductions. Box number 2 is your federal withholding. This is basically your prepayment. If it's low for your income, plus filing status, plus other income, you might be walking into a liability surprise in spring. But we can take a look at that and make some payments ahead of time. We'll dive into that deeper next. But box 12 codes are going to be where all of your benefits and retirement live. So an example would be if you're a high W-2 earner and you had bonuses, RSUs, commissions, your withholding can be technically fine, but practically insufficient once we're adding in your spouse's income, side hustle, or investment income throughout the year. But I want to be clear about this. Your payroll department is not your financial planner. They are withholding these taxes based on a form that you filled out, likely on your phone while onboarding in the company, and probably without much strategy behind it. So if you're a W-2 earner with anything extra going on the side or any other income, late January is when you're going to be deciding, do I adjust my withholding now for 2026, or do I fund the IRS savings account all year and maybe bitch about it when the liability comes in March and April? So think about that. Another thing I want you guys to think about is the difference between that W-2 and 1099. People say 1099 like it's this, like it's that. There's different 1099s and there are different meanings depending on that type of income, different documentation, and there are different audit risks for each of those. So a lot of you listening will receive things like a 1099 NEC. This is the non-employee compensation. This is your contractor work, self-employed services, anything paid in excess of $600 within that calendar year. Another one would be the 1099K. This is your third-party payment network, Stripe, Square, PayPal, depending on the thresholds and reporting rules. You can have your 1099B, which is your brokerage and trade accounts, 1099 interest, dividends, any of those things as well. 1099 miscellaneous if you're getting any sort of rents in. So a 1099 is basically the IRS saying, congratulations, you have received and touched money. Now explain yourself so we can tax you. A 1099 is, again, what they report paying you. So whether that is a client or a subcontractor or whoever, they are sending it in saying they paid you X amount so they can claim that as a deduction for their business. It is not, though, automatically your taxable profit. It should not be at all. So if you received a 1099 NEC for $80,000, let's say, that doesn't mean you owe taxes on $80,000. It means the IRS knows you took in revenue of $80,000, and now you are responsible for showing what it took and what it cost to earn that $80,000. So what are your deductible expenses here? You can do that with clean books or at minimum some sort of tracked expenses or receipts. Legitimate deductions with documentation, correct entity structure really can matter here, but properly documented reimbursement plans, any of that is key. And when it's done right, that $80,000 of gross income might translate to something that is far smaller in taxable income, if any. And now I want you to take this one step further, because for some of you, there's an even bigger disconnect. Some of you aren't getting a W-2 at all, and you're not even getting a 1099. You're getting something called a K-1. And this is where the conversation shifts from what you were paid to what you were allocated, whether or not you ever touch the cash. So now we need to talk about the one form that causes the most confusion, truly, in the forms for my clients that I see. And honestly, it is one where I see the most accidental tax problems occur too, the K-1. If you own part of a business, an S-Corp, partnership, or different investments, maybe even, you might not get a paycheck. You may not get a 1099, but you will get a K-1. And this is where people say things like, but I don't actually take any sort of money out. That's not my money. It stayed in the business. It stayed in the partnership. And yes, while that might be true, the IRS doesn't really care, and that's not how it works. A K-1 is not a cash report. It's an allocation of income, loss, and activity. It tells the IRS what your share of the business earned is, what deductions pass through to you, and how much of that income is taxable to you, whether or not you touched it at all, or if it's still in the business or was reinvested elsewhere. This is where I see people typically spiral out, because unlike a W-2, there is no withholding on this money. Again, unlike a 1099, no one is letting you take extra deductions on this. A K-1 is fully exposed unless you have planned for it. And here's the part that gets most people into a little bit of trouble. Just because income shows up on the K-1 does not mean you can automatically deduct it or use a loss from it. Your ability to do that is from an income or loss, depends on your basis, your capital contributions, your loans to or from the business, whether the activity is passive or active. And this is why I cringe when someone says, my accountant said the loss was disallowed. I don't know why. I don't understand this. It really is not a mystery. It is basis. And when the K-1s do not match what's reported on the business return, or when people report the income but ignore whatever limitations are set on that, this is when the letters start to flow in even bigger. And this is what brings us right into the next piece. Whether it is a W-2, 1099, or K-1, the IRS is doing the same thing behind the scenes, matching it to what's reported about you and about what you report yourself to the IRS and what your employer, client, whoever else is. And this is where most of the problems or discrepancies typically occur. Here is the most important thing you can understand about matching forms. The IRS does this, and they compare what third parties or other people have sent saying you made, and they compare them against what you say you made and what you report. So the fastest way to create a problem is a missing 1099 that maybe you forgot about or reported in a prior year or planning to report in the following year. Reporting income under the wrong EIN name, entity, social security number, not reconciling your Stripe, PayPal, Shopify deposits to your books correctly, mixing personal and business accounts and expenses and hoping no one will notice the difference. Let me give you an example of this. Let's say that you ran 120,000 through your Stripe account, but you also refunded 10,000 to a client. You paid merchant fees through this, had chargebacks, and potentially even paid subcontractors. So if your books are not clean, you'll either overpay in this scenario or you'll look inconsistent. Both are things that make my skin crawl and are 100% avoidable and in your best interest. So the reality is the IRS does not care that your bookkeeping was messy or during your busy season, or maybe that you missed something. It cares that your numbers match what everyone else is doing and what they can track. And that caring is not emotional at all. It is tracked via automated systems that do not consider the what ifs, just that it does not match, and that's not okay. So I want to go through a end of January checklist for you, and this is the part I want you to take some notes on. Step number 1 is going to be creating a tax form inbox. This is one folder, one list. I'm a big numbers nerd, so I use Excel, but do whatever works for you. It could even be paper. But you should be writing down every form that you are expecting to get for the prior year. This is each employer W-2, K-1, contractor, client 1099, payment processor 1099s, a bank brokerage thing, mortgage interest, health marketplace forms, insurance, unemployment income, any of those type of things. Step 2, I want you guys to reconcile this into reality if possible. So whether you have a QuickBooks Online system, any accounting system, I want you to run a profit and loss and compare the income totals to what your 1099s, your processor reports are showing, and ensure that you didn't overpay or underestimate your income from what you received on those 1099s. And if you don't have any sort of bookkeeping system, you can pull your bank statements, grab the totals, and try and reference that based on payment processor totals. At least get some sort of sanity check in there. Step 3 is where the strategy actually starts to begin. This is where you stop asking, how much do I owe? And start asking, how much of my income is exposed? And how much do I have control over that? Exposure is simply this. It is what portion of your income is already spoken for by the tax system, and what portion you can still influence with planning, whether that is mitigation, deductions, income shifting, whatever that looks like. So instead of guessing this year, I want you to ask questions like, do I need a better withholding? And this is a great question if most of your income is W-2. Withholding is going to be your first line of defense here. The goal is not to get a massive refund at the end of the year, and it's not to overfund or underfund the IRS all year while your cash flow is suffering in one way or another. Another good question I want you guys to be thinking about this year is, do I need quarterly estimates, and should I be paying those? If you have a bunch of 1099 or K-1 income, no one is prepaying tax for you. Quarterlies are not a penalty, but they are a cash flow strategy and restricting at times that keeps you from writing one giant check later, but can also be a major gain now. So another thing, if you are in a position where you have an entity or a sole proprietorship, is an entity shift maybe appropriate now? Remember, at certain income levels, I'd say 50,000 net profit each year that you're claiming, staying in that same structure isn't simple anymore. It becomes really expensive. Entity changes aren't about saving tax this year always. They're about positioning income more intelligently, even when moving forward. So if your tax savings is only by 1,000 this year, that might be taking in consideration for so much more next. Another one is, do I need to review payroll? Whether that is setting up payroll for the first time or reviewing what you have as withholdings now. Payroll is not just a paycheck. It is definitely a tool. And when it is used correctly, it balances reasonable compensation and reduces your exposure. It also does allow for supporting retirement and benefit strategies that should absolutely be employed for both your future, but also taxable benefits now. And another great one is, do I need a retirement plan? Am I saving for retirement? Retirement contributions are not just for your future. They truly are current year leverage. And with the right plan matched to your income and your cash flow, it can dramatically change your tax picture even in current year. This step really isn't about doing everything at once. It's about knowing which levers are going to apply to you and benefit you. So your strategy is intentional, definitely not accidental. So I want you guys to think of exposure as unguarded income, money that's already on the radar and unprotected unless you intentionally decide how it's handled. Once you understand what that exposure is, the rest stops feeling so overwhelming and you can start feeling a manageable plan come into place. All right, let's get into step 4. So step 4 is where smart people break the cycle. Late January is when you can decide, I am not doing the same panic cycle again, regardless if that's financial, health, whatever cycle. And here's how that actually happens. So you pick a cadence. So that could be monthly, quarterly, the very, very least semi-annually. So you're not overthinking about taxes or only thinking about them at the deadline time. You are moving your planning upstream. You actually are creating a plan before money moves, and definitely not after anymore. So you are assigning ownership either to yourself or someone qualified instead of hoping it works out at end of year, and you will see massive payoffs for this. And then you're going to build a strategy with systems. So withholdings, quarterlies, contributions run automatically. They don't feel like a punishment if they're even needed. And you're going to stop the repeating of a habit that is no longer suiting you. It's about deciding earlier and letting systems do all of the heavy lifting for you. So what is actually going to change your tax bill? So the difference between people who say they always pay a ton and the people who keep more legally, they're doing more than collecting deductions at a certain point. They are building systems that suit them and their future goals. I know I talk about this constantly, but levers are so important here. These are your entity structures, payroll strategies, accountable plans, reimbursement plans, retirement planning aligned to your cash flow as well as income thresholds. This is reviewing your profit margins and making sure you have clean months, monthly or quarterly, not annually, and the timing and documentation of everything to support it. One of the biggest things, and I know I preach write-offs and I do go through every single possible deduction with my clients, but I am not impressed by people just screaming write it off, write it off. That is great, but just writing it off, specifically without structure, is how people end up audited. But you're also overconfident in a strategy that is only going to outlive a few years if you're anyway successful. So it's ultimately a shock later when things continue to grow in liability with no planning for that. So here's what I want you to do. If you're getting forms right now and you feel even a little bit unsure, don't wait until April or March, depending on your deadline, to start operating like an owner or like you have ownership in your own financial situation. Start by asking your preparer questions. What is my effective tax rate? What was it last year? Where am I exposed right now? What changes would reduce exposure legally in 2026? But also, what do you think I missed in 2025? Do my books support my deductions? Am I structured for where I'm going or where I've always been? And if your tax person can't answer those questions for you, you don't have a strategist, and that's okay that you have a filer, but you also need a strategist. And if you want help mapping your situation out now and the one you're going to grow into, reach out to us or find someone you trust to go through these questions with you. Do some research preliminarily if you have to. But there is no shame, no chaos. There is just a plan, and it is a plan I can guarantee you will pay off immediately for you. So please take this year and make that a change in your heart and your life. It's going to be great. This is Spicy Takes and Tax Breaks. I'm Aubree Denekamp, the write-off queen. And next week, we are shifting gears. We are sitting down with Jordan Adler, the mind behind Beach Money. He's incredible, to talk about what happens when you stop thinking like an employee and stop operating like an owner in more ways than just your business. We are diving into residual income, discipline, and the systems that create money that keep working for you, even when you're not working yourself. So make sure you're subscribed. You don't want to miss this one. And I look forward to seeing you guys soon.